Welcome back and thank you for tuning in to Broker's Playbook. Today I have the amazing Stephanie Yates with me. She is a good friend since 2011 and she is my personal mortgage broker and financier. She has been analyzing and growing my portfolio amongst hundreds of my clients for the last 15 years. And she's here today with what I hope to be a very insightful episode of the show, where she shares some of her best practices, some of her best insight as to the things that you can do and implement today to grow your business and have more success for your clients. Stephanie, welcome to the show.
Thank you. Happy to be here.
Well, we're happy to have you. As I said, I am very excited for you to share some of the things that you've shared with me. And really the conversation that led me asking you to please come. I think it's important that all our brothers and sisters in the business know what you've been implementing the past, especially the last couple of years with this tough market. Give me a quick introduction of kind of your path in real estate, where you started and what you've been doing for the last 13 years.
Perfect. So I have started off in more of an admin role, just kind of learning the behind the scenes. So I got to learn at a really quick pace, but without too much risk. So there was a good opportunity there. 2013 or so, branched off on my own. I tend to work a lot with first-time home buyers, older communities for the reverse mortgage, as we'll discuss. But the last probably 5-6 years especially have been incredibly investment oriented. So I tend to work with clients who have larger portfolios. My favorite being the ones that are starting small, but we're getting there. And I've been very fortunate to be along for the ride for the large majority of my clients from Property One.
From a volume perspective, so our audience, specifically your colleagues listening to the show, because we do have a lot of mortgage professionals that tune into Broker's Playbook. What is your annual volume so people can kind of gauge the amount of deals you do and the insight you generate?
Generally around the 80 million mark. I've done over 100 for sure, like during the peak of COVID. Things have settled the last couple of years, but I'd say 80 million is a pretty solid number.
And that's kind of the stable mark, or how many transactions does that represent?
It depends. I would say probably maybe 10 to 12 a month. It depends because the volume is based on the amount funded. And when you're looking at, for example, a private mortgage, that could be as little as $55,000, but it counts as a transaction.
Right.
So it'd be hard to determine.
But you're around 100 transactions a year?
I'd say so.
How long did it take you to get to that point?
The first 5 years were, I would say, an upward hill climb for sure. It was the answering calls any day of the night, turnaround times within 15 minutes, every single networking opportunity for a solid 5 years. Once I started getting referrals who could see what I was capable of, that side of the business ran. But then also the renewals start kicking in from your own book of business. So for mortgage agents, make sure you're tracking your renewals. Because by year 5 or so, I was able to tap back into my own database and start kind of funding my own deals as well as whatever referrals were coming my way.
Well, I truly, genuinely hope that any new mortgage broker listening to Stephanie speak, I know obviously your work ethic, in kind of your business logic, because we've been together for such a long time, as far as a business relationship goes, from both referrals to your business from my database, as well as you doing my own financing required and mandates. What would be your number one piece of advice to somebody joining the mortgage industry today and looking to grow in today's business dynamic?
It's a tough market right now. So I would say first and foremost, give yourself some grace. You're not going to expect to have a killer year your first year. The learning curve is significant. What I like to recommend agents do is first partner with a brokerage that has good underwriting training. So our course to get licensed is more of a compliance thing than it is actually training how to underwrite, how to package.
No different than real estate.
Is it? Yeah. So it's kind of a shame because they just sort of let you loose and you don't really know how to see a deal from beginning to end. So if you go to a brokerage, the splits are not nearly as good, but the learning opportunity is significant. Put on that hat and go hard for a year. Learn everything you can, question everything you can, take on every deal you can, because that's how you're going to learn how to get creative and where to find all the nuances. So that would be probably my biggest piece of advice. Be okay to pay that little bit more to partner with the people who are going to train you with the actual relevant knowledge that you need.
As far as kind of making a choice to pick a niche, I like to tell my brothers and sisters in real estate, yes, you need to understand real estate in its entirety as to what it is and why people choose real estate. But more so, at some point, you have to niche down. At some point, you have to choose who you want your audience to be. If you try to serve everybody, you're doing nothing but commoditizing yourself.
Yeah.
But if you start gaining expertise and really being known as the person who fills this seat on that bus.
Mm-hmm.
I like, for example, short-term rentals, or I want to do income properties. I want to do zoning changes, like taking a home from single family to a fourplex, or whatever the case may be. Working with first-time home buyers. Whatever you choose, make a choice, stick to it, and become the all-encompassing expert in that thing. Mm-hmm. Would you suggest the same thing for mortgage?
Yes. I personally feel jack of all trades, master of none. It's very easy to get caught up in saying yes to every transaction. And I'll be honest, being in this for 13 years, financially, I'm not as motivated to do every single transaction. That's not a priority for me. But in my first couple years,
of course,
you take anything and everything. You're going to find also quickly what you don't like, which, is probably a good chunk of it. And then you're going to find things that you love. For me, I've sort of specialized in a variety of business over the years, and it's sort of organically changed in one way or another. But because I work with investors that are usually at a specific demographic, I end up working with their kids as first-time homebuyers as well.
Of course. Now the cycle is growing
right.
with us growing.
That's it. Exactly.
For sure.
So I like to say that...
So you're not 21?
22.
Got it.
Thank you for asking.
Got it. Yeah, you're welcome.
But yeah, I would say first-time homebuyer isn't even so much a niche, genuinely, for me, as it is a passion. I love the education piece of what I do.
And setting them up for success.
100%. I love them knowing every element. There's no surprises. So I take a personal pleasure from that. But investors is definitely where I've put in the time and the work.
Because it's challenging and it becomes a passion. I 100%. Very much am a investment-focused practitioner, so I understand that. But going back to first-time home buyers, I can definitely see why you want to set them up, because the overwhelming majority of people, even in the business, think that the lowest rate's the best rate. And couldn't be further than the truth.
Could not be further from the truth.
But we'll save that for a few segments down the line. We're going to take a quick break. When I come back, I'm going to have Steph share what I believe is a very, very powerful tool that's underutilized by mortgage brokers and very little known to real estate agents. And when we get into that segment, I'm going to truly have you bring the value out as to how that can immediately change our relationships and what we're able to do. Stay tuned. We'll be back in a second. Everyone, welcome back. And I am going straight into what I believe is going to be today's most mind-blowing method of finding and utilizing clients' equity into creating real estate transactions and, of course, creating winning environments for our clients first. When you explained to me the power of reverse mortgages, it took me a minute to get my head wrapped around it, because I always thought to myself, isn't that a commercial for senior citizens? Mm-hmm. The whole chip reverse.
Yeah.
And you're like, no, that is one of them.
Exactly. Yeah.
But this is like a real tool. So take me from the beginning. Let's start with what exactly a reverse mortgage is. and let's get into some advanced strategies of how to utilize this product and create wins for our clients.
So reverse mortgages are a very sort of straightforward concept. The idea is once you're 55 or older, there's basically a calculator. It's age, gender, property location, and property type. And then they sort of spit out a number of what you're eligible for. They are low loan to values, like you're not getting 80% property value. But the older you are, the more you're eligible for. A lot of people have the misconception that that product exists for people who perhaps were poor with their long-term planning. They associate it more with a need to subsidize a life than they do an actual tool in investing. And it's a shame because it is an absolutely slept-on tool, especially when you're considering rate markets like we've been experiencing.
So what makes this product so unique? Because you just said, especially in our rate environment, is there no rate involved in this product?
There is, but there's no payments. So the way that it works is that you're approved for a certain amount based on the calculation and the appraised
Let's
value.
turn this into a case study.
Sure.
I am 56 years old. Mm-hmm. I'm 44.
I'm 22.
But let's say I'm 56.
Yeah.
My home is worth $1 million and it's paid off completely.
Perfect.
Which is not the case. I am poorer than I seem.
Don't let the jacket fool you.
Don't let the jacket fool you. Seriously, I'm 56 years old. My house is worth $1 million. It is located in Calgary, Alberta. Mm-hmm. So metropolitan city, $1 million, full of equity, 56. Do I qualify?
So I would change that to Toronto just because from a provincial standpoint, the loan to values can change.
Okay.
So I would say Ontario and BC are probably the two best for this just because of the values and the constant appreciation.
So I'm from Surrey, British Columbia.
Perfect.
I qualify.
You would qualify.
Okay.
You have to have enough income to service utilities and property tax.
Okay.
So that could mean you declare, $20K, or that could mean you're a pensioner and you're just getting CPP and OAS. That's fine. There's also pretty much no credit minimum, where often with a mortgage there would be.
This is 100% equity.
100% equity based, equity, age, right? So the benefit of something like this is you'd be eligible for, let's say, 300,000. I'm just making this number up, but let's say you're eligible for 300,000. There is an interest rate that compounds as a traditional mortgage does. The difference is that you are not expected to make that minimum payment. The interest on the principal, compounds and it gets added on to the principal. So let's say you start off with a mortgage of 300,000. In 5 years, that could be 330,000. And again, just sort of arbitrary numbers, but to show you that the interest or the payments are basically added on the back end.
Are there exuberant fees or?
No.
So this is clean business, clean financial product.
They're through banks. Home Equity Bank is the most popular chip. Equitable Bank has a great reverse mortgage product as well. There are some monoline lenders who are kind of coming into the space. I think Bloom is one, and there's a couple. I much prefer the banks myself.
When you say the banks, like, are we talking about TD? Are we talking about the big five, CIBC, RBC?
No.
So these are B lending institutions.
They're not B. They're actually financial institutions. They're ranked on the A level, but they're a specific product. So Equitable Bank has an A department. With insured business, they have a B department. Got it. Which is that more sort of creative lending.
Well, I typically fall into their B business because I'm a self-employed and we have obviously a lot of property.
Yeah.
So we're part of that B lending product. And when we say A and B, we're not talking about second class property. It's a suite of products called B lending. Mm-hmm. And then there's private lending, et cetera, et cetera. So just for everybody to understand, this is not a negative connotation to what we're speaking to, rather a product line.
Absolutely.
Okay, so going back to it, Equitable Bank, amongst others, endorsed this product. Mm-hmm. They put it out. And I asked because a lot of people associate alternative lending strategies with exuberant fees.
Or private lending.
And that's just not the case.
Not the case. So CHIP specifically, their fee I think is $1,750 no matter the amount. And that covers mostly their administrative things. They'll even do things like they'll pay for the appraisal in advance so that you don't have to, especially for like the older community who maybe don't have the funds to execute an appraisal. They'll even roll that in. They are so tailored to the demographic, the service, the expectations, the forward planning. It is a phenomenal product. You are probably better taken care of from I want to say like an industry protection by that sort of lender than you would be with a traditional line of credit like a HELOC.
Got it. And the advantages of using this is the fact that we have no payments during the life of the borrower, or how does that work?
So just to rewind, CHIP will allow up to, I believe it's 4 properties. So they'll allow primary residence and up to 3 rentals or a cottage, something like that. Equitable, I believe, is only the 1 right now. That might be changing. So depending on the product and depending on the property, the main purpose of a reverse mortgage is to eliminate mortgage payments, right? So from a cash flow perspective, that's going to help an investor inject extra capital. This is not a tool for everyone. It's not to say, oh, don't make any payments and just collect big bucks. No, that's not the point. The point is when you're not at a point of cash flowing, when you're at a point of the numbers not making sense, like with where rates are right now, your rental isn't carrying itself.
That's right.
I can't tell you how many people I've spoken to over the last year or two that have come out of retirement. Heartbreaking. But how else are they going to subsidize these payments? So the benefit of a reverse mortgage is it just eliminates that problem. What you can do if you have that sort of conception where you're like, I don't want the interest on the back end, my principal's going to get too large, fine. You can make the interest only payments. A lot of people don't realize that. You can also take the money in installments. So if you're refinancing, for example, for that $300,000, you can receive that monthly as a paycheck. You can receive that in a lump sum. All of it is tax-free.
Of course.
So there's a lot of tax strategies.
It's tax-free because it's your primary residence typically.
Well, any type of refinance or equity withdrawal at this point in time is tax-free.
Got it.
So they can pay that to you in increments or as a lump sum. Most people take the lump sum, resolve any and all debts, for example. And the strategy that I enjoy most is then taking that equity and paying off or down one of the rentals to allow that to really cash flow. Once you're in that position, you can step back again and say, okay, do I want to allocate this surplus to paying down the interest? Or am I recognizing that as a cost of business and I'd rather use this to subsidize another property or just my lifestyle? It opens up doors for questions that you wouldn't have been able to ask yourself if you weren't looking at a product like this.
So as a real estate professional, how do I identify, what kind of questions do I need to ask my client to identify the eligibility, I suppose, or to have them put their hands up? What am I watching for in my clients to say, you might be a good fit for this type of product?
I would say the first thing to keep in mind is how you approach it, because for whatever reason, and I've asked many people and researched it, there is a real sort of connotation with reverse mortgages. And a lot of people hear it. And even if you educate them, they feel good. They go talk to somebody else. They come back and they're like, no, I've been told that this isn't, a good idea. So just understand that you are going to be met with some sort of hesitation. But if your client is 55 and over, if they are essentially mortgage free, or they're looking to purchase something and let's say parents are going to gift them funds, but they don't know how to get that money, the parents can do a reverse mortgage. There's so many ways that you can use this strategy.
And when are the funds payable back?
So what happens is it's the same thing as a term. You have a rate guarantee for 1, 3, or 5 year. The mortgage renews as a traditional mortgage would, so it can keep rolling on, or at renewal, you can switch back to Scotiabank if you wanted to.
But it's payable upon death?
No, so it's payable upon the mortgage being discharged. So if you're taking the mortgage from CHIP back to Scotia, you'd pay it all off in full then.
If you sell it?
If you sell it, you pay it all off. If, let's say there's 2 people married, one person passes away.
Sure.
For example, they waive the penalty. If one of the 2 people is put into a home, the penalty is reduced by over 50%. So there are opportunities to recoup the costs of breaking prematurely.
Okay.
But generally speaking, it would just continue to roll on as long as you maintain the property taxes, and the home insurance.
Great.
You can renew that until,
Well, this gives me some ideas as an investment-focused broker, and that's why I was kind of so lit about it when you first told me. It's very simple. It's a way for, let's say I meet a fixed income couple. Mm-hmm. And they're sitting on a primary residence in North York and a cottage in Muskoka. Mm-hmm. Almost every time you meet these people, those are paid off assets.
Yes.
And they're struggling with their fixed income because one was a school teacher, the other one was a government employee.
House rich, cash poor.
House rich, cash poor. Mm-hmm. And they can take money out, no payments whatsoever. So nothing changes in their life. And then they can either live and fund their lifestyle with it on the most convenient terms that could possibly exist, or they can take that money, invest in a property, and put that money to work.
That's right.
While creating cash flow, positive cash flow to supplement their lifestyles.
They could also choose to gift that money. What's interesting, and I am by no means an accountant, the feedback that I'm getting is that you can't have an estate tax on negative equity. So it's also a popular strategy for people to refinance via CHIP or Equitable or whatever reverse mortgage, provide their children with that 100, 200, 300,000 and allow them to then buy a home or invest it. So it's a great way to move some of the inheritance before there's those estate tax implications.
Interesting.
Yeah. So that's one cool thing. The other strategy that I like, and so a tool is as good as the person who uses it, right? You've got to try to be a little bit creative. But one of my favorites is a client of mine. Actually, I think it's a mutual client. They had sold their home. Husband had some credit issues. Income didn't quite qualify. So we put his mom and dad on title. And with the amount that they had available for the down payment, they qualified for a reverse. So now mom and dad live in this house, no mortgage payments, but so do our 40-something-year-old clients who have no mortgage and no rent payments. And so do then their kids. So this gives them an opportunity to, one, live for free, essentially, capitalize on that revenue and bank. It also allows them to then buy their own property owner occupied because that property is already under the parents' names, right?
I just think it's one of the most brilliant tools I've ever heard of. Yeah. And it comes at a time in someone's life where they're already stable with a firm understanding of economic responsibility and kind of fiscal responsibility. So I think it's just such a strong product that you can literally twist and turn into whatever you want.
Absolutely. And I think most people's concerns is always like from an inheritance standpoint. They're worried that they're, taking away from their kids at the end of the day. And that's just simply not the case, insofar as the monthly amounts that are compounding would have been out of pocket regardless. And if you're then leaning on other means of capital, lines of credit, credit cards, at some point we have to take a step back and say, okay, yes, you want to establish an inheritance. Yes, you want to set up your kids for the most generational wealth that they can. I would say hyper-focusing on the mortgage is probably the least effective way to do that, and appreciating that you can utilize those funds without your parents having to sell that $2 million home in North York that they bought for $200,000 700 years ago.
Yes.
Right? That continues to ride. Refi that. Buy another one. Refi that. Put tenants in it. But go buy your own downsized
The brilliance in this is when you ask mom, dad, can I get some help? You have a ton of equity. Everybody assumes they have to refinance and incur now a brand new payment.
Yes.
That we simply as parents don't want or we cannot service.
Fixed income, pensioners.
There is the solution.
Absolutely.
Not only is there not a payment, there is nothing.
Nothing. And what's really great is when they can gift their kids this down payment that allows them to put 20% down, because then you're also saving your kids the insurance premiums.
Which is significant.
The PST on those premiums provides a longer amortization. So you want to talk generational wealth, set your kids up now. That is going to be what is most beneficial to them.
And this is a tool that literally applies, I would say, to maybe 50% of parents with equity to gift.
Yeah.
So it's, anyways, it's a fascinating tool. And I do hope that this inspires some thought in all the real estate professionals listening to this. And of course, mortgage brokers, if this is the first time you're hearing it, hey, this is your chance to
do some homework,
reach out to you and ask questions, figure out how you can implement it into your business. But from a real estate agent perspective, like the minute you said that to me, like there was at least 10 calls I could make instantly to say, hey, remember how we spoke and at the end of the day we couldn't do it because you wouldn't be able to service the debt? Well, guess what? That's no longer a concern.
And the really cool thing is, and what I strive to do as a broker, and I attribute a lot of that to my success, I just don't like to say no to my clients. And if you are making $20K a year and you want a $300,000 mortgage because you want to help out your kids, that's a no, right? There's no bank that's going to qualify you. Those ratios are out of the water.
Yeah, it's impossible.
So we look for other tools and other solutions. And this is perfect for that. And they have a no negative equity guarantee. Another misconception is, oh, if I die and my mortgage is 1.5 and my house is 1, I'm strapping my family. That does not happen. They will not go above the value of the home, even if it's a loss to them. So it's good to know these things as a realtor because
these are backstops.
Yeah, and you can kind of plant the seed in advance and say, oh, you know what? Like I just learned about this. It's pretty cool. Lay a couple of those cool points down and then let them speak with a professional who can kind of take it from there.
Yeah.
Because you can only go so far, I feel, as a realtor without sounding pushy.
Well, and also it's not your core tenet of your business. You are not a mortgage broker.
Yeah, true.
Like bring the concept to enable the actual transaction and or entertaining to look at it, but then pass the puck to the person that's going to put it in the net.
That's right.
We're going to take a quick break. I thought that was brilliant. And we're going to get into some alternative home equity solutions that can be used again in a market like we're in right now. Stay tuned. Welcome back to Broker's Playbook. I am having a conversation with Miss Stephanie Yates. Blue Standard Financial is the company you're with. What is your favorite way of getting in touch with your colleagues in realtors?
So Blue Standard is the sort of entity that I own, but my license is through Mortgage Center. Mortgagebroker.ca is the franchise. Fantastic brokerage. I should be getting into social media. I know it's a point of contention for a lot of people.
Of course, you're 22.
Yeah, exactly. Yeah. So I'm just kind of getting in that space,
TikTok dances.
Yeah, exactly. Mortgage dances. They're the riveting stuff. Email's usually best. So it's syates@thebluestandard.com. Also, cell phone, call, text, kind of old school.
All right.
Maybe fax.
Well, I like that. Maybe fax. I could make some sounds for that. In this segment, I really want to cover off something that's more of a sign of the times. As you very well know, myself, my business partner, Jazz, our team, above and beyond resale and income properties, we sell a tremendous amount of pre-construction and new construction property. To put that into perspective, between 150 and 350 deals a year between myself, Jazz, and our team. It depends on the year. So during the peak, we were probably at 350 to 400. Now we've leveled off in the 100s, simply because that market's not moving, and we're going to talk exactly why. But the problem that has surfaced in the last 2 years is not so much the activity, it's so much what's happening with completions. To all my brothers and sisters, realtors, anybody who's in the Toronto or GTA pre-construction scene, or the Vancouver pre-construction scene, Montreal pre-construction scene, we are seeing buildings that have now come through construction to completion. And as they go into occupancy and the mortgages are coming up, appraisals are coming in. And there's two issues that I want to address with you today. One is, what happens to the people who bought in 2018, 2019, who because of COVID are delayed and are closing 6-7 years later? They bought at prices that don't exist anymore. And their units are worth considerably more than what they paid for them. But still, they have a hard time closing because of the closing costs, the HST components, all these government changes and levies and taxes and meters, and it amounts, a closing that used to be 20 to 30,000 is now 60 to 80,000. How can agents bring their clients solutions for condos that were pre-purchased a year ago worth more money today? Because we're also going to get into the ones that are worth less money today.
Yeah. The ones worth more, condo or any sort of pre-construction, there are two lenders, BMO and Equitable, in large part, those two are the best ones to work with, that allow you to do up to 80% of the appraised value as opposed to the purchase price. Equitable does have a limit that they can't go as a mortgage higher than what the original purchase price was. BMO doesn't have that. So there's still definitely some restrictions, but the idea is to advance the equity you've already earned to help contribute or afford the entirety of the closing costs. That's kind of the goal. It's a fine line in making sure that those numbers still work relative to your rent. But, you know, there's many ways to win in real estate, but not one project is going to hit all of them. So, you know, we take that into account.
Well, I personally had 3 closings in a matter of 60 days. Yeah. And we deployed that very strategy on 2 of them because both of them were bought so long ago where the equity was significant. My appraisal was higher than the purchase price, and we were able to leverage that strategy to get my closing costs.
That's right.
So for anybody to understand what the benefit of that is, it is the difference of using equity built over years to finance those costs versus me having to reach in my pocket and covering those dollar for dollar.
With your after-tax dollars as opposed to tax-free equity.
So the benefits are very significant.
Yeah.
Maybe we should repeat that.
And you can write it off too.
Maybe we should repeat that. So I was able to advance funds on equity accumulated over the past 6 years.
That didn't cost you anything because you didn't have a mortgage during that time.
Correct. To take those dollars instead of after-tax earnings, and our tax brackets are not insignificant.
Right.
So we're using money that we can write off as an investment to pay off charges that would have been paid with after-tax dollars, only to create further expenses that we can write off on the current investment.
You got it.
So it's a triple win off the bat.
Off the bat. Especially given, if we're, you know, spade a spade, most people are not pulling closing costs out of their TFSA. They're pulling it off of a HELOC, a home equity line of credit. It's not free money regardless. In fact, a home equity line of credit is likely more expensive than what it would be to roll it into the new mortgage.
It still works because you can write that interest off as well.
Absolutely, yeah.
It still works, but at the end of the day, it's the best option would be to use an upward appraised property to cover off expenses. I love that. Going to the more unfortunate side, which is the side where you bought a pre-construction investment and the appraisal came back and short. What solutions do you propose to your clients in those types of scenarios? Because it is not an unlikely scenario right now.
Yeah.
It's actually, I would say almost 4 out of 10 are under appraising, not because they're worthless, because the appraisers are so conservative for the bank that they don't want them to have liability. More of a fear factor.
Yeah.
Regardless, how do we help those clients close on their mortgages?
Speaking from one agent to another, not necessarily to a client, first thing I would say is make sure you're aligned with good appraisers. They are not all the same. Also, little things like pooling all of your clients who are registering at the same time to the same appraiser. Little things like that, believe it or not, really do help stack the cards in your favor. They can only do so much, but we'll take what we can get. If ultimately it doesn't appraise, the first step is that we protest value. We'll reach out to the realtor, get comparables. We really do fight to do what we can to get it there. Failing that, the truth is the bank will just lend based on the appraised value, up to 80% normally. We try to get creative with other ways, like if they've got a child who's over the age of 18 that can go insured and we don't need an appraisal. That's one loophole. You don't have that. Okay. Do you have another property that we can refinance, pull out some of that equity and offset it, or do a quick second mortgage and then consolidate it when the condo value comes back up? So there's other ways.
There are ways.
There's many ways. It's not what the client thought that they were going to be doing. So there's also a lot of educating. And it's, as to your point, it's not a failure. It's not to say that the investment was a bad one or that the value isn't there. It's a matter of the market and the snapshot. Once you're past that and you've closed and you've funded, it's a working investment, and then you wait.
Listen, anybody trying to win in real estate by timing the market is always going to be outperformed with somebody who's putting time in the market. And that is, I just had an interview, an amazing podcast with Michael Saraceni. That's where that saying comes from. Michael is the founder of Keyspire. He teaches investors about, how to go into the market, what to expect. And that is the number one thing, because you called it a snapshot. and we call it a cycle, and you call it whatever you want. For anyone trying to time a cycle or to predict a cycle, you'll be sadly disappointed.
Yeah.
People have been trying to do this since the beginning of time unsuccessfully. So
And everybody has that one friend that did it.
That's right. Yeah. But everybody has a lot more friends that didn't
do it. Yeah, we don't talk about those friends.
So I think if we were to stick to the fundamentals of that, we're going to be okay. But those are tremendous strategies. So you're saying, so I'm just going to try to recap this because you covered off maybe 2 or 3 strategies in a matter of 3 sentences.
Sorry.
So for all of us who have clients who bought real estate, let's call it in the last 3 years, inside the bad cycle. They bought let's call it a condo for $700,000. Appraiser goes out for closing and it's at $650,000. Obviously, they can pay $50,000 out of their own pocket.
Sure. Yeah.
Close the deal. In the absence of the $50,000, you're saying if they have a family member that is over the age of majority.
Yeah. So most people are aiming for generational wealth regardless. So sometimes we're just getting that generation brought in a little bit sooner, especially with the first time.
Are you assigning or transferring the deed to your child's name?
So you'd be assigning the purchase.
As well as the deposit.
Yes.
So they can qualify.
They can gift the equity as a parent.
Got it.
Yeah.
And then because that would be an insured mortgage.
They get the money back.
And no appraisal.
That's right.
It would be the
Sometimes you do need an appraisal with insured, but more often than not, you don't. And with the new sort of rules that have rolled out with first-time home buyer pre-construction specifically, you can get a 30-year amortization.
That's right.
And that's going to help with the payments as well.
And Stefan, all these things are newly implemented into the market. There's a bunch of things that the federal government is implementing or has implemented just in the last few months that are going to make an impact. Can you tell me a little bit about those programs?
What's interesting is that there's been quite a few kind of coming about at the same time.
And with not a lot of detail.
With almost no detail.
Right.
And no detail even for the brokers, for the banks, for the BDMs. None of us have been given any sort of VIP info, any advances. We kind of know what you know. But there's changes to capital gains, as we know. Yep. There are changes to first-time home buyers, what the minimum down payment is, what the max purchase price would be. A very popular one right now is that on renewal, if you're switching your mortgage, you don't have to be subject to the stress test. A very important distinction is if you are switching, not refinancing. And basically what that means is if you take the exact product you have, the rate and loan size and amortization, sorry, not rate, just loan size and amortization, and you bring that to a new lender as a vertical move, you do not have to qualify for the stress test.
That's pretty significant.
It is, because it now means that you're not married to a bank that may not be treating you well. It gives you the opportunity to move where a lot of people don't have that.
So is that because a lot of people were stuck and there was a position where like, this is not right?
Yeah.
Give me the choice.
Especially now with rates being what they are, because stress test is rates plus 2.
Yeah, it's insane.
Right? So there was times when we were qualifying people for an A product like Scotia, BMO, TD at like 9 something. So not a lot of people are qualifying in that way.
Well, I truly appreciate that. And I think the 2 major strategies, and this is the kind of the pre-construction world that I brought up earlier, knowing the options that we have for those with significant equity when closing to those who have less equity when closing, because both scenarios are happening right now as a result of that 3.5-year COVID logistical supply delay period. I think it's going away by next year. We're not going to have this disparity.
Yeah.
But we had projects since 2018 that were supposed to deliver in 2022, projects that were supposed to deliver in 2025, delivering now.
Yeah.
Like, it's all this crazy.
Yes.
It's a crazy market.
Even the occupancies.
Just all of it.
It used to be months, and now I've had some where it was days.
Because we went from 3-year delays to a year early in some cases, and it's just a bizarre market to build in. And no matter what we say, reality is what it is, and we can't help it. So having these strategies has been very helpful. Steph, I truly appreciate that we were able to cover off the 2 major segments. You know, all the agents who have clients with equity closing, they can provide them with a really smart solution that they're going to be looking like heroes. You know, taking that built equity, burning it and turning it into a way to cover the closing costs and or more, put money in their pockets at the end of the day with market money. And on the other side, the agents who have clients in the unfortunate situation of short appraisals. There are solutions. There are some things to explore. So it's a matter of education and putting them in touch with the right professionals.
And putting the effort in.
I want to thank you so much for joining me. This is the end of the Broker's Playbook podcast. We do have a few segments for the extended version.
Perfect.
Stay tuned.